And that brings us to the next point of the checklist is whether the company has a recurring revenue or the established customer base who purchase a lot of times from this particular brand. If you are the brand ambassador or the loyal customer and the business has the product which can be used a lot of times throughout the life of the person, it can prosper because you will eventually receive more cash flow, more revenues and net income, which can give you more advantages in order to make this product better and improve the life even better. And you will be financially stable because if we compare this with the industry with the one-time purchase, you need a lot of money in order to promote your product or service and acquire the customer, and then the customer just leaves. So in most cases, these businesses with one-time purchases are not so financially stable. And from my point of view, I try not to look for many times on them as well. What do you think about that, Nick?
I like this point. This point has been made by one of my favorite investors, Tom Gardner, where he talks about rule makers. And that would be sort of companies that manufacture their products and sell them at a low cost to people who buy them repeatedly on automatic. The automatic is really the focus of what Tom was talking about. So, for example, when you go to the store and you buy your orange juice or Coca-Cola or whatever, you don't think about the alternatives that are right there in front of you. Odds are you didn't even look at one brand name that wasn't the one that you always buy. So you reach in, you grab your orange juice that's always the same brand every time. You go to the front desk, you pay for it. You don't think it through. You don't compare them. So those low cost manufacturers that like sell these automatic purchases because you're familiar with the brand, you're almost addicted. You don't even think about it. You take all the shortcuts mentally. You probably don't even see the competition. That's kind of a wonderful company where your customers are kind of locked in almost for life. It takes a lot to get them to switch. Even if that automatic orange juice purchase is more expensive than all the other ones on the row, you're not comparing price at 20 cents extra or 30 cents extra. You're just buying the one you know is going to be what you're looking for. That's definitely the automatic reoccurring purchase is a wonderful one to put on your checklist. I do like that kind of company as well.
This brings us to the next one is the understanding how the company grows. It's not only about the recurring revenue. It's more about the methods of how the company is making money. And it can be either by selling its own product or service and improving and increasing the scale of it. So for example, when Apple just sold iPhones or particular phones, right? And you can just do only that. And you can sell it in particular state, in particular country. Then you can go from United States to Europe, etc., etc. The next level, I think, is to acquire some competitors. So in this case, you receive higher market share and you can grow even more, which can bring you a more competitive advantage because you become a larger company and the businesses which enter the market will hardly compete with you. The third, and I think this is one of the most advanced techniques, and I also try to look for such kind of companies, is the companies who not only grow their own products and they not only buy competitors, but they try to acquire businesses and run businesses in different spheres. Because in this case, even if something happens with the particular product or particular industry, they're not dependent on it. So for example, like Tencent or Amazon. So for example, you are tightened with the e-commerce like Amazon did. And there are some problems with the logistics and all these things. And you can be hit by that and your revenues can decrease. But on the other hand, you will also have the cloud business, which is completely different field. And this business can grow. The more businesses like that in different jurisdictions, in different spheres you have as a business, the more stable you are financially. And in comparison with the huge growth and recurring revenue, and always what we spoke about previously, it can be very, very powerful stuff, which can actually increase the price of your stock. Because actually, these businesses can grow forever. They can just acquire different spheres and develop in different countries, different business niches, nonstop.
So I like this. There's a lot to think about the different ways that the company can grow. When a company wants to grow vertically, that means they're staying in the same niche and they're maybe acquiring their competition or they're growing their market share or by moving into different countries or by running really good advertising. They can also grow in that vertical by lowering their costs and so thereby increasing their margins. Or they can increase their price, which also increases their margins. And then if they grow horizontally, which means pushing into other industries, that does add that extra sort of diversification and safety, so that if their primary business is hit by something, their secondary one can make sure that those figures aren't too hurt because you've got those additional income sources. And if they've done a really good job, maybe they even hedge against each other. So when the one suffers, the other one can prosper, and thereby smoothing out those kind of troubles. I do like considering how can my company grow. One of the questions I ask on that topic is, what is the potential for them to grow in the next 10, 20 years? How much bigger can they get? Because there's no such thing as infinite growth, but there is often a very large amount of growth. So, for example, if you're looking at a fast food chain and it's dominating maybe the Southwest, but they've still got the rest of the country that they can grow into, you can safely say they can probably do another 200 stores per year opening, and they'll be okay for a long time. By comparing them to their competition that's in the same sort of niche, and you see how many stores they have nationally, and you go, yeah, they've still got space to grow. So it's good to look at what is the possibility of growth. Some companies, maybe there isn't so much space to grow, and so you need to factor that into your considerations. Maybe they've grown at 30% a year or 40% a year, but now they're reaching the peak of that market, and so you should lower your expectations of growth rate.
As we said in our previous episodes, the more people are on the market, the more approaches to investing everyone has. And it's completely up to every one of our viewers to decide for himself what is the best approach for him. Either this can be the purchasing of different businesses or the acquiring the stock of the company who developing the particular products in particular niches with a huge markets. But anyway, we will still continue to analyze the list. And the next point is the understanding of the management and understanding the motivational structure and most importantly, the strategy of the CEO. I have the little example here. So recently I analyzed the company. It's a middle cap company and it has like 500 million in sales, but the company is barely making money. So it's like 10 million plus for 500 million in sales. So clearly there is something is going on. And I went to analyzing the management and I understood that the whole management had the motivational structure, which was based on the adjusted EBITDA, not the net income or not the just different KPI points of improving the position of this particular company on the market. And then I went to analyzing these adjusted EBITDA numbers throughout the history. And I saw that in most cases, these numbers were pretty good because the all management and CEO, CFO, and other guys received their bonuses in percentages based on adjusted EBITDA. But when the adjusted EBITDA was positive, the company lost some money. And it was throughout the whole history of this company. So in this case, we really need to understand how the management is motivated and is it the great and right motivational structure, which can benefit the business in general and which can bring the benefit to the shareholders at the first place.
Yeah, this is a great one. I've found throughout my life that in business, having your employees, whether they be a low-level employee or a C-suite employee like a CEO, having their incentives be aligned with what is desired of them is so crucial to the success of the business. If you pay someone and the metric that they are judged by is the wrong metric, they will make sure that that metric shines at the detriment of all other metrics, and you might actually be harming your business by having them judged on the wrong metric and incentivizing them basically to do the wrong thing. And this is exactly what we see with CEOs a lot of the time. The wrong things are being measured, and so they are actually harming the company. So seeing what their metrics are, that the KPIs of how they get paid, what rewards them and what doesn't reward them, it can tell you, are they going to be doing the right things for the company or not.
Yeah, definitely. And it is really, really important, which we need to consider before making the investment. You see, most of these points in the checklist are really not a rocket science. So we are not analyzing here the financial reports or different numbers. Of course, they're important and they need to be considered. But now we're speaking about the completely different things in which most of the investors just do not start thinking about. And the next point is the understanding in connection with the management. What is the strategy of the CEO? The next question is also, is the CEO and the top management considers their work and their being in the company like they are owners of the business? And do they have this mentality of the owners? Here is the little example as well. So suppose there are two businesses. In both businesses, there are CEO. And in first case, the CEO just does his job from 9 to 5, and he does nothing more, doesn't think about the customer. He just cares about the numbers, and that's all. And the other CEO in the second business, he has the mentality of the owner. And every time he comes to the the work, he thinks about how can we improve and be beneficial for the owners. Maybe he will put some flowers on the entrance. Maybe he will change the way people welcome the guests if it is a restaurant, etc. Or maybe some bonuses. And if you would be the customer, where would you go? And where would you be most welcomed, and which would have the most better atmosphere? Probably the second one. And that's why it's so important to understand the strategy and the understanding of the mindset of the particular management. It is also very important to consider the strategy of the CEO, because something different can change every time in the business. So, for example, if the management was crappy and the CEO has changed and he has completely different understanding about the business and the strategy for the next 3 to 5 years, and he has a great track record previously, but the company lost money in the in last years, several years, we can actually assume that something can be changed. And in this particular case, if we understand that the business is really great and the management will be better after the year or two, this can be a great investment and a great way to enter right now, because when the market understands the value which the new manager will bring to the company, it will be maybe already overvalued. This is the end of this episode, guys. We will continue next time. And if you have any questions, please write them down in the comments below. And see you next episode.